Next up is our Fuel in the Deal panel. I'm going to hand it off to you, Matthias.
Awesome. Well, first and foremost, thanks Dominic and Rice University for having this conference. I've learned a lot just even listening to the first of the panels that was moderated by Chris Vera at Midwest EPA. In this specific panel, we're going to be covering debt and equity and hearing from different perspectives from both the SBA debt side, SBA and conventional debt side, as well as the equity side with traditional search from Tatiana Gasper, as well as self-funded search equity with Jake Paul. So my name is Matthias Smith. I'm the founder and owner of Pioneer Capital Advisory. We are a boutique white glove commercial loan brokerage firm based in Madison, Wisconsin that works with self-funded searchers nationwide that are buying enduringly profitable small to medium-sized businesses to help the next generation of American acquisition entrepreneurs go from start to finish through the SBA financing process. Just to give some detail on us, in the last 3.5 years, we've helped 112 clients get $240 million of SBA financing. And so we're going to kick things off here, getting perspectives from this awesome panel of different folks. And so just to kind of start from the top here, for a question for Tatiana, tell us about traditional search funds and how they give institutional backing for business buyers.
Yeah, absolutely. So we work with entrepreneurs from day one, right? So, and you're thinking about the universe of entrepreneurship for acquisition and all of the different paths that you could take. In the traditional search model, you are putting no capital up front. You're fundraising equity so that you can fund your search. And then what that does is it puts together a cap table of partners that will be effectively your team, hopefully for the next, almost decade as you go through with your acquisition and through the operations. So with that, we are backing entrepreneurs from that day one and walking alongside them and supporting them throughout the entire process. So that includes the search itself, thinking through the strategies, get creative, troubleshooting, all of that good stuff, all the way through to LOI negotiation, seller relationships, ultimately diligencing the deal, key bets, key risks, due dates, all of that. And then operational oversight, we sit on boards. There is an expectation that if you're going down the traditional route, that you will have a board that will be composed a combination of your investors as well as industry experts. And so as you're deciding which direction to go, you'll find that, there are different characteristics of each path that you're kind of signing up for. I'm happy to share more details, but that's the high level.
Awesome. So Jacob, you live in the self-funded search world where operators find the deal first and then the capital comes second. So when someone brings a deal to you, what are the top 2 or 3 things that you immediately want to see to determine, is this searcher in this deal worth that?
That's a great question, Matthias. So I would say that the first thing most people think about are the technical skills that come to mind. And so I feel like those are almost the table stakes for whenever we're talking about potential buyers who want to make sure that they have a certain amount of business experience, preferably P&L leadership, leading a team, and definitely some financial acumen. But to be honest, some of the things that we're really filtering for after that, since that's kind of the minimum expectation, we're looking at things that are more soft skills and we're starting to look at a lot of the qualitative aspects of that buyer. So we want to see that they're very self-aware, that they're motivated, and that they have a very high EQ, because a lot of what gets deals done and obviously as to the performance of the business after it's been acquired is the role that operator plays, how well they can communicate with people, how good they are motivating the team and things like that. And so those are a lot of the characteristics that we're looking for. So maybe a couple extra that we look for is grit, compassion, honesty, things like that, because those are all very important, and not just during the search phase, but also the operator role. So we're trying to envision that. I would say that most people, when they first think about approaching a capital writer, they tend to overemphasize the technical skills. And for us, that's something that we can get comfort with fairly easily, but we're trying to screen for those other intangibles.
Super interesting. So how does one go about testing for those soft skills?
I would say a lot of it is question and answer, and then you get feedback from being able to communicate with them. So it's kind of a two-way interview process. We should be learning from them, and then hopefully they're interviewing us as well in order to make sure that things are a good fit. So as you talk through questions, you'll kind of sense if somebody's coming across. I think the last panel they talked a lot about being able to connect with some of the sellers and about how some certain amount of arrogance coming from a top-tier MBA or things like that can really turn people off. And so we're looking for those exact same clues that a seller might be looking for in order to try and understand how they communicate with people. And that usually comes across in a lot of our initial conversations.
Interesting. So Jacob and Satya, so both of you guys talked in past interviews about how the operator matters more than the deal. So for first-time buyer or first-time buyers in the audience, what are some tangible and real ways that they can signal readiness to equity investors before they've closed on the deal?
Yeah, I'll jump in. So I think one of the potentially key differences in how Jacob and I are kind of coming in, at the point in which we come in the process is that I imagine, Jacob, you're looking at the entrepreneur and then also looking at the deal, right? And like the combination of those two. When we're backing an entrepreneur and we're coming in from day one, there isn't a deal yet, right? And so we're underwriting to the individual, which is of course very challenging. I would say we're looking at a lot of the same things that Jacob is looking at. I think it's evaluating, can this individual find the deal so they understand what it takes, which is hard, and then can they ultimately run a business? And so approaching us already with an understanding of, how does this traditional search model work and why do you want to go down this path as opposed to a different one? Showcasing some of the characteristics which Jacob already explains quite beautifully, which is a lot of what we're looking for as well, I think is incredibly important upfront. And then the last thing I'll say, because we don't have a deal, we should have alignment, right? And so there's an investment criteria within the traditional search kind of universe, if you will, that is well known and that institutional investors and others in the space will ascribe to you. And so having an understanding of that and what kind of business you'll find that will fit within that criteria, which includes a margin profile and size, low customer concentration, a handful of other things. And so having an understanding of that and kind of, I don't want to say constraints, but what you're getting yourself into really and what you're looking for and kind of presenting yourself of, this is the path that I want to go and this is why I want to do it is important. And so having that alignment up front, knowing that you'll find a company that's going to be within the industry, generally the industry that you're looking for and within that criteria is really important up front. Because again, there's not a deal at the time that we're underwriting the entrepreneur.
Super helpful. So it sounds like for both of you guys, the operator in their background when they're trying to decide traditional search, so for you versus self-funded search, and what they're looking for is paramount. Because for you, it needs to be someone that really wants to support like the strategic guidance and the very hands-on, whereas for you, Jacob, not as much so.
Yeah, I think it's pretty common for people to go down the self-funded search route because they want to not have a supervisor, not have a boss that they're reporting to every day. And I think that thought process kind of directs a lot of their actions and their beliefs. And so we have to be very aware of that because we're there in a supporting role. We're not there to operate the company. And so we are a little bit more removed from the front lines than you might get in different structures.
Completely makes sense. So we're going to camp now talk questions on the financing side. So we're going to first go to the Callaway of the room, George Johnson here, the first internet bank. So let's talk about how some of these pieces come together and how great deals can ultimately die sometimes. So Jared, on the SBA side of things, with what you're seeing, what are some of the most common structural mistakes that you're seeing in the acquisition financing space now, and things that kill momentum before a deal even reaches credit? So like post-LOI, pre-term sheet, some of the earliest you saw.
Yeah, I think one of the biggest problems we have are that people are not reviewing any LOI with a lender that they're planning to award with. So a lot of times I'm going to get an LOI and they'll look at it and right off the bat I'm seeing things that are not SBA eligible, or there's something in there that is going to set the deal up for failure ultimately. So a lot of times what we're seeing is the way that it's going to be structured, or a seller carry note. Oftentimes I'll see a seller note that is on a very short term. And so when we're applying that to the actual debt service coverage, it doesn't work. And so we're having to go right back right away, right off the bat, and say, hey, you're going to have to change all of this. So it can become pretty frustrating for a seller that just got excited about accepting an LOI and then having to go back and change everything right away. So most of the time they're not reviewing it with a lender that they're planning to use. And ultimately, most of the lenders are going to look at it the same way if they're in the space. So it's not really the lender's fault. It's that they didn't review it properly. And so the way they have it set up is just not going to work. So there are oftentimes when you go back to a broker or to a seller and say, I need to change these things. Not only does it put you in a bad position for the rest of the transaction because now they feel like, you do a little bit of bait switch, but sometimes it just ultimately kills the deal altogether. So it can cause a lot of problems. That's probably one of the biggest things that I see.
So one question kind of adjacent to that, I know like someone like yourself is super busy, have lots of inbound. At what point in time does it make sense if someone's pre-LOI to reach out to you so that's not too early stages and there's enough to kind of dig your hands in on to get the beers in the deal? What is that for per points on?
Yeah, I think that's probably the biggest question I ever get is when to reach out. And I always tell people, whenever you're ready. But ultimately, it makes a lot more sense for us to look at the transaction together before you issue an LOI. If somebody's just searching and they're looking at different transactions and they want to get someone else's eyes on it, we're looking at thousands of transactions every year, so, and doing it forever. So a lot of times I can look at an industry and I can give you 5, 6, 7 questions to ask right away. I can tell you what I've seen on my other transactions, what's working, what's not working. So I'm always free to look at deals and help them along the process before they actually move forward or even ultimately decide that they want to go forward. And there's a lot of people I'll work with sometimes for 2-3 years before they even find something and actually close on it. So although, being busy and having a lot of inbound, a lot of email, a lot of stuff, that's still one of the things I really enjoy. So I'm always happy to do it.
Super helpful. So pivoting from just the SBA side to both SBA and conventional, Shelly, tell me about how you're making Comerica most of the deals from both sides, and with SBA versus conventional, what the difference is between like burning size when one deal makes sense to be SBA versus conventional, and typically like what type of profile do you want to see for the buyer if they're doing conventional versus SBA? Does it have to be more experience or are you first time buyer?
Sure. So both are great tools to have. So our relationship managers are completely indifferent, whether we go SBA or conventional. We're just looking for what is ultimately going to be the right structure for any opportunity.
Now, both of our acquisitions that are by like individuals that are especially like
First time doing this are going to go SBA. But there's limitations to SBA. The biggest being that it's, $5 million cap. So sometimes I have individuals that are looking to buy a business and, they're trying to stay within that range so they don't exceed the 5 million. But then it turns out that what they're looking to buy is actually a company that has no management team, just a handful of employees and no set processes and questionable financial statements. And that is very risky, right? And so I would encourage searchers to think overall about, yourself and what you're comfortable with rather than limiting yourself to try to fit into an SBA bucket, because you can change, the risk profile by buying a larger business. And that can de-risk if it's got, a strong management team, if it's got quality financial statements, if there's true value you could bring to it. But it does look very different, right? With the SBA, there's minimal down payment, oftentimes as little as 10% and sometimes 0 and depending. Whereas if you were to do a conventional loan, usually the implication there is that you're going to need to have some sort of equity investor coming with you. And so that has implications of itself, but once again, could also help de-risk the opportunity. So when we're assessing opportunities, we're looking at it from both angles and just trying to see what fits best for the particular profile.
Super interesting. Where would you say kind of the current environment, if you make at least, the inflection point is on what in deal size makes more sense to go SBA? I don't know if you guys do the period to sue versus conventional. Is that around like 2 million of earnings, or where would you pinpoint that?
Yeah, I mean, it's very difficult to go pursue, like do an SBA loan and a conventional. Usually in those situations when we're doing that, we're having to go to the SBA and ask for the SBA to subordinate their collateral to us. And in those situations, we have to be very specific about the collateral that they're willing to subordinate. And that can be a limitation if the company does not have much collateral, right? But in those instances, it is something that we can do if we're getting up to that over $5 million threshold. Additionally, there's instances where we'll go in and we'll do an SBA, a 7A loan, but maybe we're maxing out that position. And so then instead we're having to do a conventional working capital loan. And once again, having to get that AR, if there's inventory subordinated for that line of credit.
Got it. Super insightful. Thank you. Tatiana, talk about when your firm is investing in deals, how you look at the implication of the bank leverage on what the sponsor can accomplish from a growth standpoint. So like covenants, things of that nature. Where do you encourage the people that you're working with to have more working capital, less leverage? How do you think about that?
That's a great question. So let's start with how much debt. So usually we'll advise folks to stay under 3 turns of EBITDA, around 30% of the capital structure. Sometimes it's a little bit higher, again, depending. But the idea being you're a first-time operator, you're coming into a business, potentially in an industry that you have no experience in. Once you take out debt, you have to answer to the bank, of course, and you have the covenants that are tied to the debt that you just took out, right? And so there are certain restrictions around what you can or can't do and how much cash you have to have. And of course, you have to make sure that you're not breaching any covenants. The more debt you take, the less flexibility you'll have to take that cash flow and put it towards growth. And so there's definitely a balance in there that comes from this kind of advice that we're talking about of like how much debt to take on. And of course, the bank's also going to tell you what their limits are, and they're probably not going to got to go too much higher than that. And so it'll depend, but I think from our standpoint, we want to make sure that the entrepreneur has the room to be able to make some mistakes, which will happen, right? Sometimes we'll see some EBITDA compression or margin compression, right? Post close within the first 12 to 18 months because you're investing in the business and you're hiring people, and sometimes it takes a little bit for that to be reflected in revenue. And so to be able to have that flexibility, I think is really important. And so all of these different factors are kind of coming into how much debt we think folks should be taking on.
Interesting. So Jacob, back to you here kind of on the investment side. So as you know, because you can get into the weeds on financials and similar when you're working with sponsors, not every deal is perfectly clean. All these deals have hair on them, especially in the SBA finance space, even more so than Tatiana space. I'd presume, to make presumptions. And sometimes there are risks around things like customer concentration, seller transitions, working capital dynamics. From your perspective as a minority investor at the cap table with Condo Capital, how can you structure deals in a way to really manage those risks while still keeping the operator investors aligned?
That's a really good one. I think that maybe this is a great time to point out that this is where having the partners is probably very, very important. So that's where we reach out to your banking partners. If you've got equity partners or potentially have equity partners, that's where they could probably get a lot of feedback to be able to help you address common issues that you might run into. So specifically in some of the cases that you've listed as far as customer concentration or different things that you're trying to solve for in the transaction itself, you can get very creative with seller notes, even in the SBA world, and some forgivability or have that tied to historic metrics. In a case of non-SBA financing, you can utilize earnouts, rollover equity, along different mechanisms in it. So it really depends on what type of problem you're trying to solve. And that's where a first-time buyer probably doesn't have the repertoire of experience in transactions that they've viewed to really think through all of the implications of what types of structures might solve the issue they're trying to solve for. And that's where I think reaching out to lenders, equity partners, anyone that you have with your deal team can be really helpful at that stage, because they could probably help you to craft that offer in a way that both meets the seller's needs and is compelling for them, but also address the downside risks that we're trying to protect for as an investor, and also that buyer should be trying to protect for, because at the end of the day, we all want to see the deal be successful.
So back to the comment that Jared made earlier about getting involved pre-LOI to really screen through some of those variables. Is there, let's say someone here in the audience wants to buy a business and they're contemplating, working with SBA finance or working with an equity investor like yourself. It sounds like, if I'm not mistaken, there's a huge benefit to pulling you in earlier to really kind of get your hands dirty, go through some of these things, assess things like the customer concentration to make sure it will be an offer from the investment side.
I think so. I think different investors have different views on this and when they want to be involved in the process. Some only really want to be approached whenever deals under LOI for one reason or another. My personal belief is that we're trying to build a relationship with that searcher, and so it's really important for us to get involved early and upstream for all the same reasons that Tatiana talked about earlier. We're trying to build rapport with them, understand how they approach business problems, how they do their analysis. And so we prefer to be involved very early in the process, probably not at the point where someone says, oh, I just discovered this new thing called ETA. It's probably a little bit early to go out there and reach out to an equity provider. Although sometimes I talk to searchers that are at that phase too, and that's okay. But usually once somebody is beginning to get repetitions and evaluating deals and they're progressing towards a deal where they think that they want to make that first LOI or where they want to get very serious about that buying process, that's usually a perfect time to engage us, because then one, we get the opportunity to work together, and we might be able to give them some tidbits to help them out with their structure and transaction. And then we get to start that process of building a relationship to see whether or not we think we'd be a good fit for one another working together.
Super helpful. Jared, I'm going to throw you a two-parter because you look like you're ready to get that in here. So talk about post-close liquidity and how you've kind of seen that evolve as far as what you as a lender in banks and SBAs in general want to see in 2025 relative to 12, 18 months ago. And also talk about when you see someone like Jacob in the cap table of a deal, does that decrease the way that you think about the risk because you know that he's underrated it or another equity provider has also kind of dove in and done their diligence in the deal?
Yeah, great topic. Yeah, as far as working capital goes, I would say the big majority of issues that we see after a transaction is closed is working capital. Outside of some of the other things you can't control, like what is the seller going to do, how is the business actually operating, which is nearly impossible to completely understand until you actually get in there and operate it. So working capital can always help you after the fact. There's so many things that people talk about. We all talk about J-curve, right? But outside of that, the other thing that we're not talking about is the amount of deposits that you're having to pay for things. People viewing it. I can't tell you how many times people come to me and say, first thing that happened to me day one was one of my key employees walked in the door and said, hey, I want to raise. Obviously, you need me. Give me more money. And so you need to have working capital at the end of the day. We could talk for 3 hours about why, but what we've been sort of pushing and having done this for a long time, when 15 years ago, if we tried to say we're going to put working capital into a deal and fund it with an SBA loan, our credit team was like, absolutely not. They need to have post-close liquidity themselves. We're not putting money in, and they're sort of arguing with them like, you're setting up to fail. And after years of sort of like grinding on it, and then fortunately having kind of a newer wave as the credit people come through the banks, they're starting to actually see that it's important to have the working capital. If they're not having enough to operate the business and even going above and beyond that, you're setting yourself up for failure. So we're always pushing to include that or to add it to the transaction. And tying in, same thing, and working with someone like Jacob. If I'm seeing a transaction where he's already on it or he's being brought in, we're usually going to get more comfortable with the transaction for a couple reasons. The main one is they're also looking at it as a partner. They're kind of letting us know if they're seeing something we're not. And there are times where we talk to each other and say, hey, I didn't realize that the searcher was having this issue or whatnot. And we're able to, the individual, that the seller, we can have separate conversations about, is this really a deal that all of us should be doing? Should we be bringing in more equity? Do we need to find another equity partner to kind of tag along with? There's a lot of conversations we can have there that get us more comfortable. The other thing we like to see, and we're starting to see a lot more now finally, is that the operator is going above and beyond and raising more capital than just for the injections they can put on the balance sheet. So we'll always include working capital, but there are times where we run into that $5 billion cap and we're just sitting there kind of trying to figure out how is this person going to have enough working capital. They also have a lot of times where someone's main goal right away is to acquire something and then go out and expand, maybe roll something up or grow. And without having an enormous amount of liquidity to do that, you're sort of going to grow yourself into trouble. And so having an equity partner that can come in and put money on the balance sheet and also still meet all of the equity requirements that SBA has, and sometimes even going above and beyond that so the leverage is less, really sets it up to be a nice deal. And if we had more people do that, it would be great. The challenge we run into as a bank is if I tried to enforce that, then they're just going to go to another bank. So it makes it a little difficult to say, we want to do good deals, but we also just want to do deals too. So the more people that can kind of change their mindset and sort of blending, kind of two different sides of the search world and using debt, of course, because it's necessary, but trying to lower that leverage, bring in more equity and have a good amount of working capital. Every single searcher you talk to a year, 2 years later, if you ask them what is something you wish you did, almost all of them will say, I wish I had less leverage and I had more working capital. So start out that way and it's going to be a lot easier. Also makes it a lot easier, I think.
Definitely an interesting dynamic too, because the more working capital you fund into the SBA loan, the more down payment funds you have to have. But if you don't have enough after you buy the business and they're going back to yourself or whoever the lender is and asking for a pay or asking for a line of credit, it makes it challenging.
Yeah, I would say I would rather you call me in a year, pay down the loan, than call me in 6 weeks and say you can't make payroll. And everybody always said, oh, I see what you're talking about 2 months later when they tell me thanks.
Yeah. So on the working capital side, when we were questioning for you before pivoting, how do you look on the margin on financing dollars on a line of credits, the SK Express line of credit versus permanent working capital? When does it make sense to do one versus the other or both?
I would say anytime you can, try to get a line of credit. It's a lot easier, like you were talking about, coming back and saying, hey, I need more working capital. If we have maxed out the limit on the Express line of credit, it's a lot easier for us to push that up to that limit later on if we need to. And it also gives you sort of buffer. And then depending on the industry, there could be seasonality. It could be a long time to collect receivables. You may need an operating line. But I typically will leave it up to the searcher to kind of explain to me what they want to do with the working capital, what their goals are. And then we'll try to work together to see, does it make sense to do just a line or do permanent working capital and a line? But I usually try to split it up so that they still have the line there. And again, we can always come back and increase it later. Whereas when someone comes back and says, hey, I want a line of credit now, so we have to go all the way back through the whole process. And a lot of times it turns more into, are you having problems and you're trying to save the business rather than you're trying to grow the business and you're hamstring because you don't have the working capital?
Awesome. Well, things are...
Can I add a thought afterwards? So on the equity side, so you can also raise, I think was mentioned, additional capital from your equity holders to be able to put that cash in your balance sheet at close, right? That's also an option. Of course, that comes with cost. You do vision to be about that. But what I think in the deals that we're working through, so there's a working capital peg, right, that gets negotiated with the seller that's effectively confirming that there'll be a normalized working capital number when you come into the business. So effectively saying you can't just take all the receivable and leave it with all the payables, right? And so there is some level of agreement in there that you're going to come into the business in a cash-free transaction and that you're going to see money flow in so that you can pay your bills. So that is hopefully being negotiated in your purchase agreement. But what you can do on top of that is that you have a timing consideration, or if you want to put cash on your balance sheet for growth or to acquire something else, or there's several different reasons as to why you might want to do that. And we do work with our searchers to, obviously context is relevant. I mean, it's not a case by case, but that the entrepreneur can raise that additional capital to be able to have the cash from day one on their balance sheet for those different purposes. Actually, are about to close on a deal that the lender said, hey, we would feel a lot more comfortable if you guys put like 100K on the balance sheet at close. And that was fine. The searcher is raising an additional 100K and that we're good to go.
So the takeaway point here for everyone in the audience is more working capital is always than less. So Dominic is fighting. It's time for Q&A now. So who has questions for the people in the panel?
Thank you. I would like to pick on your brains on how you see this lockdown, the impact it has on the SBA in terms of the current business environment. If there is someone adventurous to make forecasts, I would really appreciate that.
Do you want to stay over?
I didn't hear the...
What's the shutdown?
Oh, okay. Yeah, great question. So the way that the SBA lenders work, when you have a loan that is approved internally, most of us should be lenders, we're essentially having to go into a system called eTrant, and we put the information in, it gives us a loan number. Basically, securing the guarantee and those dollars for that loan. Right now, we can't do that. So any transaction that we have that we do not have the loan number, we're essentially having to wait, continue to work on the transaction as if we do have that loan number and we're ready to close. We're going to have to wait until that's done and we're back online and able to pull the loan number. So depending on when it actually comes back online, it could really delay things. It's definitely causing some problems. I think like 30 or 40 transactions right now that we're just having to wait. Some of the other stuff we're running into is I have 2 transactions where the seller's main revenue source are covering the contracts. So we're going to have to try to figure that out as well. So that's definitely causing some issues.
I'd say that the key there is that we're still working through them,
Yeah.
right? But there is at some point where a deal can't, like everything is done and all they need is the loan number. But, we've gone through this the past couple of years. So it happens and it's industry wide. So most sellers are understanding, although certainly patient.
It's my understanding that SBA loan terms are pretty standard. You see brokers all the time saying, hey, come work with me, I'll help you get a better SBA loan or whatever that is. So what are the differences that you see in SBA loans, or something that you should look for or try to stay away from specifically? Because every broker says they're better than the other one, and I don't understand what makes them different.
Yeah, so happy to feel that one, and then sure to feel your perspective. As far as like a term and amortization, pretty much it's all gonna be the same. So if you're buying just a business with no commercial real estate, it's always gonna be a 10-year loan term, fully amortizing. If you're buying a business with real estate, if the real estate is at least 51% of the whole budget, that'll be 25 years. Now, the variance is typically in the spread over prime. So prime being the index that SBA loans are indexed to, so currently 7.25%. And then things like how much working capital the bank will give you, will they do a line of credit, and things of that dimension. And so the interest rates typically hinge on the bank's economic model. Is the bank one that sells their SBA loans on the secondary bond market, or is it one that portfolios? But I would say, generally speaking, from what I've seen, the range in interest rates is about 250 basis points from low to high. And so I've seen a deal close at 25 or 0.25% over prime, 7.5%, but then I've also seen them close at 2.75% over prime. But basically, the lower the interest rate is, that typically reflects lower leverage, so you're bringing a lot more cash into the deal and maybe not accomplishing what you're trying to.
Yeah, I think that's good. And outside of that, I think it's important to understand that every SBA lender is very different. So we all have to follow the SBA guidelines, but then each lender is going to have their own appetite as well. So depending on industry, depending on length of time in business, and there's so many different things that come into play. So, and then on top of that, there's really, as far as like I've kind of tried to figure out, there's probably 4 or 5 lenders that are doing like 70-80% of the transactions when it comes to acquisition financing. So you want to make sure you're working with one of those lenders, and then working with a broker. Typically, the kind of the benefit is that the broker knows who those lenders are and who will do what. So you're not having to kind of shotgun approach and talk to several different lenders. But most of the time, if you're working with someone that's in the space that has been doing it for a long time and does a good amount of volume, they should be able to tell you right away if they can do the transaction. If not, who else can do it as well.
I would just add, there's also a difference between whether you're working with, like for us, we're a relationship bank. And so the expectation is that we're not just doing a loan, we're having your entire relationship, which is why we're able to price the way that we are. And then there's other lenders that can probably get the deal done quicker because they're more transactional. It's like what their focus is. And they don't expect to have the full relationship. And there's pros and cons on each side, but that's another like foundational difference.
Hello, my name's Nick. If the SBA continues to be a challenge and probably more people start going for conventional loans, like what creative deal structures are you seeing? And how are people innovating if SBA is less and less of an option, if speed is a priority? What are some ways to close those deals in a more innovative way?
So just to kind of clarify the question, if we have a prolonged shutdown, what will people do?
Yeah.
Yeah, so I have some thoughts of my own. So, I mean, optimistically, I feel like cooler heads ultimately prevail. You know, like all hell will break loose if the government is closed for months on end. That's just my perspective here, of course. But I think a couple different things. So one is, you might see deals where it's majority seller financing equity and then like a sliver of bank debt at closing. But I think ultimately some of these deals, candidly, like ones in the SBA space, conventional banks aren't going to do them on the same risk profile. So ones that use customer concentration issues and similar. And so there might just be M&A sitting on the sidelines if that were to occur. But I'm an optimist. So.
I mean, I would agree with that. The structure will look very different, and you'll have to come up. So everything is creative. When you're doing a conventional acquisition loan, everything is completely customized. And so some of the things that we'll see is like rollover equity a lot. We'll see maybe contingent portions where, you know, if you don't reach certain metrics, then you're not going to get paid out this, you know, extra $1 million. And there's different tools that you can use in the structure and the negotiation, but everything will look very different. More money will have to come to the table. The bank is, you know, looking at assets, how much of a unsecured, you know, unsupported portion can we get comfortable with, and your amortization is going to be shorter. Instead of having the 10 years, you'll get it 5 to 7 years. It might be something like cash flow recapture too. So if the company is doing better than expected, exceeding, you know, the fixed charge coverage ratio is usually what we'll put on those, then you need to pay us back, you know, a certain percentage of the extra cash flow that's coming in to accelerate outflow payment down.
Are you willing to do a conventional loan for any size business?
So if it's a business where, you know, there's 3 employees, no. I want a conventional, I'll do a conventional loan on something that's not good strong bones, good strong management team.
Thank you so much. Just a question from Tatiana and Jacob. How do you differentiate yourself, you know, against the family offices in terms of providing capital? Go first.
In terms of differentiate ourselves from each other, or what was the exact thing?
Family office.
No. Comparing to the family offices. You know, let's say, you know, I want to get into EO and I have the option, family office versus ISO. How do you differentiate yourself?
Yeah, understood. So when you're getting yourself into the traditional search space, you're signing up for a handful of things, right? And with that comes, you know, the hands-on support, the equity upfront to be able to fund your search, and, you know, the operational oversight and all of that. There's a lot of overlap, I would imagine. At the end of the day, the traditional search model, though, has the market terms that it does. And so you have a very good understanding of what you're getting yourself into upfront. Solo searchers can invest up to 25% of equity. Partner searchers 30%. That's usually a larger acquisition, though. So in absolute dollars, it can be on average relatively similar in terms of outcome. And so it's very attractive. They're very attractive terms, and there is very much so a playbook in terms of how the model operates and what your expectations are of, again, what you're getting yourself into, what kind of business you're probably going to buy, what that's going to look like, what your operational oversight is going to look like, how much equity you're investing into. And so it's having a little bit more of that certainty, which I would imagine in a family office situation, things could be potentially a little bit more bespoke in terms of what their expectations are, in terms of their involvement. I would say that is kind of the key differentiator, in my opinion.